Hello, and welcome to ETF.com's Inside Commodities Week series of webinars. This week we're having 5 straight days of information and interviews about various pockets of the commodities world, from futures to hard assets to the finer points of commodities indexing to gold, and finally on Friday we'll finish up with MLPs. Today's webinar, which will take us into the world of commodities from the broadest perspective to the most finely calibrated, is titled Commodities versus the World and Why They Are Still a Valuable Investment. This is a complimentary ETF.com webinar, courtesy of Bloomberg Indexes. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, I'd like everyone to know that they can ask questions at any time during this webinar in the window at the lower right of your screens. And this presentation will be available to all of you 24 to 48 hours following today's webinar. Joining me today are Carolyn Abramo and Zeth Lokhandwala, both of Bloomberg LP and both based in New York. Also joining us is Paul Smith of the Mobius Risk Group. Carolyn is the Commodities Indexes Manager at Bloomberg Indexes, and she spent the past 15 years in the world of commodities and in banking and alternative asset management. Zeth is an energy market specialist at Bloomberg, and he has worked as a portfolio manager for much of the past 15 years. Paul is the Chief Risk Officer at Mobius, and he has over 17 years of financial markets trading experience. Most recently, Paul was with one of the world's top 5 producers of oil and natural gas, where he ran the North American Financial Derivatives Trading Desk. Bloomberg Indexes was born in 2013, and there's little doubt in my mind that the company that, by dint of its vast success, turned Wall Street's term for instant messaging into Bloomberging someone, will also have success in the world of indexing. As part of this push into indexing, in April of this year, Bloomberg announced an extension to its strategic partnership with UBS, whereby Bloomberg is now responsible for the calculation, distribution, governance, and licensing of the former DJ UBS Commodity Index family. And as part of this deal, early this summer, these leading commodity benchmarks have been renamed the Bloomberg Commodity Index family with the primary ticker BCOM. This partnership is the second major acquisition or partnership this year for Bloomberg Indexes, the other being an acquisition of the UBS Australia bond indices business. Now, today's webinar comes at an interesting time for the global economy. The long slog out of the Great Recession continues, with slowing growth turning negative in key areas such as Japan, and even the Eurozone's locomotive economy, Germany, risks sliding into recession as well. It's fair to say that more than a few people reckon that the China-driven commodity supercycle that reared its roaring head in the early years of the 21st century is over. But that does not mean that commodities have suddenly become unimportant or irrelevant, and that's what the title of Carolyn, Zev, and Paul's presentation is all about. Again, commodities versus the world and why they are still a valuable investment. My guests will paint brushstrokes both broad and narrow, focusing on the macro case for a variety of commodities, and not least, they'll be drilling down to describe the finer points of how the rubber meets the road, namely some of the cutting-edge indexing methodologies that Bloomberg Indexes is now marketing under the brand name Bloomberg Commodity Index Family, and they'll particularly emphasize the roll select indexing methodology. To put this in broad perspective in terms of the ETP market, an excess of $35 billion is now invested in U.S.-listed futures-based ETP commodity strategies. And there's no doubt that the ETF and ETN wrappers have opened up this pocket of the investment world in ways that were just about unimaginable 15 years ago. So, on that note, it's my pleasure to introduce Carolyn Abramo of Bloomberg Indexes. Carolyn?
Thanks, Ollie. It's great to be here with our team. We wanted to again, talk from a high level about the macro influences on commodities at the present time, and then go into a more micro look at what is driving the commodity forward curves right now, which is particularly important for commodity investors. Just as a little background, Ollie, thanks so much for the introduction about Bloomberg. We entered the index business in 2013. We have a suite of fixed income commodities and currency products. In 2014, we partnered with UBS on the BCOM, which we renamed from the Dow Jones UBS Commodity Index, and now we are the administrator and marketer for BCOM. BCOM is actually the headline index, which has 22 exchange-traded futures on physical commodities. There are actually 2,000 BCOM sub-indexes. You can look at single commodity indexes. You can look at forward indexes, the F3, the F6, and roll select. And we'll talk a little bit more about roll select later in the presentation. As an overview, we wanted to really talk about three main areas. First, as I mentioned, the macro variables, inflation, dollar, and real interest rates. Jeff is going to talk a lot more about that. Number two, micro factors such as commodity supply and demand and hedging practices of producers and consumers and how they affect commodities. And this might be an area that the audience is not as familiar with. It is called the bastion of real commodities. What is really going on out there? In the real, let's say, the plays that have been happening in the U.S., the shale revolution, the nat gas revolution. We've seen a lot of supply coming on the market. How is that impacting the financial markets? And I think earlier in the week we heard some words just about this idea of physical commodities versus futures commodities, the futures market. We'll be speaking specifically about some of the physical drivers. And then just in terms of what's happening in the physical world, what opportunities does that present to investors? Quite a few actually, and we'll go through some of those. So without further ado, I'd like to hand it over to Zeph to talk about the macro influences.
Thank you, Carolyn. In all the years that I've been involved in commodities, I have to say commodities are most interesting when they either go up a lot or they go down a lot. Lately, we've had one of those situations, especially with oil. So if we look at this little chart here, the lower oil prices have a huge stimulative effect on the global economy. And this chart is my attempt to kind of put that into context. QE3 has been phenomenally successful in bringing our economy out of the depths of what could have been a very nasty recession. And you know what? QE3 was only $790 billion. When I count the effect of lower oil prices, it's more like 1.1 trillion. This is huge. If you count, energy is approximately 15% of the global economy. The stimulative effect of this is felt throughout economies across the entire globe. There are big winners and big losers. Also bear in mind, the dollar has become much stronger. So these lower oil prices are not benefiting everybody evenly. In countries with strong currencies, in the US, the stimulative effect is huge. In Europe, not as much. In Japan, hardly at all, because the yen has been trashed. In rubles, it's actually a negative effect. They're getting squeezed on both sides. They're getting paid less for the oil they export, and the ruble's weaker. So they're having to, they're importing inflation effectively. So this is just to kind of put things in context that commodities are in a situation where they're a big macroeconomic driver. If we jump to the next slide, just to put things into historical context, this is a multi-year rolling chart of the correlation between inflation and commodities. The top chart is essentially expectations of 5-year inflation as indicated by the zero coupon TIPS market. The chart below shows the correlation between inflation and oil over many years. And we do the same thing for gold, for copper, and the BCOM index. Now, the last several months, commodities have been less interesting simply because we've been in a world where volatility has been low, correlations have been high, dispersions have been low, and some might argue Fed policy had some role to play in that. Technological advances that improved the supply of some of these commodities, especially oil, also played a factor. But if you look towards the right of the screen, you can see the correlations are starting to creep up, in most cases except for gold. So gold is kind of dislocated from the rest of the commodities, inflation, currency story, and there are many specific reasons why, and that's a debate for an entirely different discussion. If we go on to the next chart, another big debate is how much does the dollar drive commodities? And you'll find people who are very passionate about this subject. Some will say that the dollar is a very, very relevant variable in pricing of commodities, and others will say it's completely insignificant. So to try to put things in context, how relevant is the dollar really to the price of oil, to the price of agricultural products and metals? This is my view on it. Essentially, the dollar, a strong dollar makes oil more expensive in other parts of the world. So it helps demand. It helps the demand situation in the U.S. and the big importing countries, including India, China, and so on, and much of the Middle East, believe it or not, is a big increasing consumer of oil. So essentially, the dollar has a bigger impact when it has big moves, is my punchline from this whole discussion. I'm showing the correlation between oil and, for example, again, oil, gold, copper, and Bcom. Again, you'll see gold is kind of behaving a little differently than the rest, but the longer-term correlation picture is intact, and the numbers are creeping back up. This next slide is just my attempt to show you that on a day-to-day basis, the correlation between oil and currencies is extremely low. It's noise. But if you look at a longer-term window, a monthly or even a quarterly window, and you go back 10 years or more, the magnitude of the correlation increases, and it's much higher in oil exporting countries. So I've used Norway, and I've used the British pound as an example also, since there's a big North Sea exposure component to the UK's oil situation, and the Mexican peso. So essentially, the correlation between commodities and oil-producing countries is higher on a longer-term basis using lower frequency, wider window data such as quarterlies. If we go to the next slide, you can see the impact on the credit cost. So it doesn't, if you're trading emerging market rates, if you're trading currencies, you can see that oil is a big driver, and hence the Bcom index effectively gives you instruments to manage the exposure in your portfolio across a very wide range of portfolio characteristics. So it doesn't matter if you're fixed income, foreign exchange, if you're trading equities. You're not just buying into a Bcom type index because you necessarily want a commodities directional view. You're also using it as a portfolio hedge, and it's a very versatile tool that can have many, many benefits. It essentially improves the risk-adjusted return in many different portfolios. So on the next slide, what we can do is, if any of you in Bloomberg Terminal and you have this economic workbench, it's the ECWB command. This allows you to take real-time pricing data that you get from, in this case, retail gasoline prices, and measure the impact of retail gasoline prices on the U.S. Core CPI. The Core CPI number actually leaves out the volatile food and fuel component from the calculation of the CPI. But lower gasoline prices have a ripple effect, especially at the lower strata of society. You might calculate that the average American family is saving approximately $1,000 a month. $1,000 per family for the year on these lower fuel prices. And that is more money for them to spend at stores and restaurants and movies and so on. So it definitely, and the lower CPI also has a huge impact on portfolios, on rates, on core rates. Lower CPI numbers, essentially maybe gives the Fed more ammunition to be more stimulative for longer. And this just allows you to aggregate the different data. So here what I'm doing is economic data that's reported on a monthly or a quarterly basis. It's an attempt to match that with real-time pricing data that you get from the retail gasoline market. And I've aggregated it on a monthly basis and using year-over-year changes to compare with the CPI numbers. And if you run some stats on this, you'll see that the relationships get a lot better as you sort of manage the reporting windows correctly. So this is a similar kind of thing on personal consumption. The stimulative effect on personal consumption can be monitored throughout a whole range of industries. It affects virtually every other sector out there. Energy is a big input cost into a wide range of industries. And these are, again, this is if you have any portfolio that's based on an increase in personal consumption, you may consider one of these instruments as an effective hedge against that type of exposure. So I've just taken a few minutes to outline some scenarios where something like a BCOM commodity index or one of the products based on the index or the energy index or the ags index or a total return index. We have a lot of tools in our toolbox that we can apply to essentially construct a better risk-adjusted portfolio-based returns. With that, I'll hand it back to Caroline.
Thanks so much, Steph. So now we'll move on to some of the more micro factors that are affecting the commodity market. I want to introduce Paul Smith, who's Chief Risk Officer at Mobius Risk Management in Houston. Mobius has been in business for over a decade. They concentrate on risk management for producers and consumers in the energy, metals, and ag sectors. They talk to C-suite in terms of the management of these companies and in terms of acquisitions, divestitures. They've been very integral in some of the trends that I talked about in terms of the proliferation of energy plays in the U.S. And they really have a good pulse on what's been happening over the last decade, in terms of prices, not just in the near term, but in the far term, and the behavior of the participants in the futures markets that are not the institutional investors. So with that, I'm going to hand it over to Paul. Hi, Paul.
Hi, Carolyn. Thanks very much. So we're going to talk about a few things about the commodities markets and some kind of what we think are aberrations, and possibly bring those to light in terms of what some opportunities might be on the institutional side. But just to give you a sense of what our firm does and what we've been doing for, I guess over a decade, is that we work for public and private E&P exploration and production. We work for capital providers either at the portfolio level, or they'll drop us down in the portfolio companies. And we also work for end users of commodities across many different verticals, such as pulp and paper, petrochem, steel, aluminum, and so forth. And so the information that we get, because we actually do the managing of the portfolios as agent on behalf of our clients, is that we're long information from both the physical side, because we arrange for the marketing and also for the procurement of physical molecules, and also we manage the capital structure or the plan, the financial plan, on a financial basis out across the curve. So we're from 15-minute power all the way to Cal 22 oil, for example. And so we see a lot of different things that I think that the market doesn't see. And even from the dealer desk, we see a lot more on how risk is being managed. And we have particular insight into really strategies and the issues that we face, because we face it from both the consumer side and also the producer side. And so we'll tell you what we see in the marketplace, and maybe some of the causes on why these events are happening, and then maybe bring to light some opportunities, and think about also where some alternate opportunities might be in the what we call the more regional markets that are getting deeper and deeper. And we're going to bring some examples in from oil, from natural gas, and also from aluminum. But this page titled Duration Mismatch wanted to address what we see in the longer term spreads, and we think that there's a duration mismatch, or in other words, the natural buyers and sellers are not aligned across the term structure. And by that I mean, if we look at energy in general, the natural buyers of commodities, particularly call it natural gas, got run over after the run-up. So we'll call it the 2006, 2007, 2008 run-up in natural gas prices, when everyone thought we were running out and the economy was going and blowing, that they stepped out on the curve kind of as their normal discipline and maybe put in 3-year hedges, and they put them in at $8, $9, $10 example for natural gas, and if you recall that price curve, it certainly dropped since then. So as a discipline, I think that from the end use side, from the consumer side, risk management programs have really been reined in, and it's because they felt burned and they talked about hedging losses, and I think particularly on the utility side, there was this look-back option from the PUCs where they could say, well, why did you do that? And it says, well, it's part of our mandate. Well, let's change the mandate. So I think that certainly lower volume hedges from the consumer side and the tenor of those hedges has shortened up. And this is exactly the time when we've kind of gone through this resource play in especially energy in the U.S. On crude and on natural gas, where the odds of finding oil and gas especially have gone much higher with the shale plays. We know where it is, and we have a much higher probability of finding the molecules that we can go sell. So therefore I can lever up my balance sheet, and I need hedging. So I've got to step out on the curve. And so it really depends on what kind of a seller I am. If I'm an MLP, then I'm stepping way out on the curve. If I'm a high yield borrower, I'm stepping probably 2 to 3 years out. But I think in general, as anybody's looked at how the cost structure of delivery of molecules for U.S. energy has dropped, then you're competing with that cost structure. So therefore, my hedging program may mean a whole lot more as I try to manage my CapEx, any kind of fixed costs, and certainly my debt service. And so natural buyers are shortening up tenor, and the producers are in need of greater tenor. And so where that duration might have met in the middle at 18 months, it's certainly a lot wider right now. And so we've certainly noticed that in terms of liquidity, which we'll get to in a second. But effectively, this duration mismatch is getting warehoused by the market, and it's more dependent on the market to manage it. But just as we're facing what we're calling a new liquidity paradigm. So if we look at what's happened in terms of liquidity in the commodities markets, we have effectively a new regulatory regime that has done a few things, but certainly one is the cost of capitalizing trades as a result of Basel III has made effectively the hurdle on running a commodity business higher. But I've got to allocate more capital from a more concentrated pool, certainly as a bank, to capitalize those trades. And so it gets expressed in a couple of ways. It's either lower volume because I don't want to allocate resources as a bank to that, or as a bank to that business line, or you get wider bid-ask, certainly across the term structure. And as we step out into the term structure, it's getting wider and wider. So I think that is one issue. It's more expensive to run a business. The Volcker rule pulled out a lot of what we call internal prop desk capacity, and I use an anecdotal measurement, but 2 or 3 years ago, when the Volcker rule was getting rolled out and people were getting in front of it, the internal hedge funds at banks especially provided a great deal of capacity, provided a great deal of back-end liquidity. And when they pulled out, we looked at in the energy markets alone, it pulled out something like $200 billion of capacity that used to be deeper in the end, that understood the spreads and could step in there and really put them back into shape and where they ought to have been. I think what also happened with respect to liquidity is the position limits certainly affected hedge funds and how much they could put on. That's, again, coming from Dodd-Frank. So we have a more expensive business to run. We have lower prop capacity from kind of the big internal hedge funds, and then in the external hedge funds, certainly position limits were reined in. So all of a sudden, everything gets jammed up into the front, and so most of the capital is in the front. And so,
Paul, can I jump in really quickly? Just to quickly interject a question. You're speaking at a high level for sure, and I'm wondering, in the interest of advisors and investors who are, okay, what does this mean if you're eyeing a particular ETP? Some of them which, you might have quite a lot of liquidity, at least in terms of their assets under management or value if they're ETNs. What does this mean? I mean, we're talking about, it sounds like it's analogous to like bond desk not holding as much inventory, and the whole market is looking a little different than it did even a few years ago. Is this a case of buyer beware, or is it more subtle than that?
Well, I think, and I'll give my answer, maybe Carolyn wants to apply as well, but it's really setting up an opportunity for maybe a different kind of ETF or maybe even a different kind of indexing. And so when we'll get into a couple of examples of where the curves are, but really what's happening, we can even move to the opportunity of what we're seeing, is that there's this mismatch in where the buyers are and where the sellers are, and that's expanded, and then all of a sudden what normally keeps those spreads in shape would be, would be capital. And so what we're arguing is that capital will find a solution to either compress this risk premia or find a way to capitalize or find a way to capture it. And we see the opportunity, and I think what's happening now is that banks are under a new set of eyes, a new set of rules, so they're dropping out of physical commodities, but merchants are building out new capacity, and we see it as new merchant businesses get funded, additional capacity gets put on to the merchants. But what we think is, what we're calling the alternative funding solutions is where liquidity used to be a solution to keep these values in alignment, it's just not there anymore. And so I think that the opportunity is, how does capital come in, either from an ETF perspective or from a different type of indexing, to really capture these this compression, or to force that compression of the risk premium.
And I would add that, so matching the institutional flow onto this producer-consumer flow, you see 95% probably bid of institutional flow is in the first 12 months of the curve. And for many of the reasons that we described in terms of that's where liquidity is thin. However, it's about the generation of products, and Ali, you alluded to this in prior sessions in terms of where we are in terms of as an asset owner, you look to a benchmark, you look to a commodity allocation. Where do you go first? I go to the benchmark. The benchmark decom rolls either one or two to the third contract or the second contract, very much in the front of the curve. Our peers, same thing. That's been the first port of call. The next has been, creating roll opportunities, looking at premium out the curve. That has been where most of the alpha is being generated today. I guess we would argue that there's additional alpha and additional premium that's not visible to the institutional clients right now because this market has gone, the banks have gone away, nobody's making markets. The spreads have become extremely volatile. So it's interesting, we talked about volatility of commodities being lower across the board in general, and that is true. But the volatility of these spreads is at all-time highs, and so it makes it very hard to trade. But having said that, there is extreme opportunities, and there are a few products that are out there that take advantage of this current trend, or have over the last couple of years. They've been kind of the early movers, but we argue that some liquidity is coming back into the market through new players, and this is a structural shift that has to occur because we've had such dramatic changes from the regulatory environment and from a physical environment of just more energy being out there, more metals being out there. It is just a rebalancing. So that will take some time to move through the system, but as we do, we should be focused on this area and looking at those folks that are going to build more liquidity and then creating the products that can take advantage of it for the institutional set.
So I just want to clarify the reasons for this big structural change that you guys are identifying, and I'm really keen on hearing the opportunities therein with a little bit more detail. But you're saying this is a function of broad changes in the macroeconomy, some ongoing regulatory projects. Is the great downturn of 0809 part of this, and in a more superficial sense, the pullback that we've seen in commodities over the past few years since the downturn? I mean, all these get stirred into one big pot that equals structural change and slash opportunity. Is that fair?
I mean, it's fun. It's just like all these things happening at once, and you say, well, oh my goodness, how could this all happen? Well, guess what? It has, and so there's many things going on, and I think that's what's happened in the market there, where, frankly, all the news that you hear today is about outflows in commodities, and we are in a part of the cycle, which, commodities trades in very long cycles in terms of booms and busts, and there's that opportunity. We're at a low point in the demand cycle, and it's, Zeph pointed to a lot of the macro factors that have caused this down cycle, in terms of overcapacity and China slowing down, all these things. So there has been outflow. But interestingly, in the boom period, leading up to this, so let's say up to 08, you had a tremendous interest in commodities. You had asset owners that were trying to add commodities into their asset allocation mix, moving some portion of fixed income and equity into commodities as a diversifying part of the portfolio. You alluded to, some of the papers that have been out there that, facts and fantasy about commodities, looking at this as a real premium market. And so it took a long time for people to get there in terms of their allocation, and then, oh my goodness, we hit 08 and prices rise, and then, we go into a global recession. And strangely, a couple of years later, that's really when people started to get the most of their allocations in and started to really invest in the commodities and invest in these kind of first-generation products. And we've seen, outflows, and we've seen, pretty poor performance. And that isn't so strange considering where we are in the cycle. So it's, it really is many factors coming together that seem negative on the, on the face of it, but when you dig deeper, you see, wow, actually, there have been a lot of people that have added commodities to their portfolio, at least from an allocation perspective, and there's opportunities in the commodity set that now that we have these structural changes that have been created. So I think there's a lot of opportunity right now. Anything else to add on that?
Thank you.
I absolutely agree with Caroline. I mean, I want to emphasize the fact that, lumping it all into one basket is a simplistic way to look at it. But if you look at it on a granular basis, the impact is very widespread. Every one of these things is a different opportunity. The regulatory impact is a different opportunity. The supply situation that we're facing today is an entirely different range of opportunities. And this recent pullback in commodities now is basically due to a supply situation. The last two pullbacks were demand shocks. It's much easier to cure a demand shock through Fed policy and through stimulative government action. A supply situation becomes much more interesting. It's much more structural. And people tend to sort of generalize this into one big net effect, but I really want to emphasize that there are many different underlying forces at play. And every one of these has a different impact on different people. It doesn't matter if you come from the industrial side, if you're a big real money guy, you're a hedge fund guy. It impacts everybody in a much wider range of ways. And I just want to emphasize that, the danger of lumping it all together is that you lose the forest from the trees.
Fair enough. Yeah, I'm definitely interested in the indexing / ETF opportunity. I'm grinding my own axe there, so you guys know where I stand. But no, this is all very interesting. Thanks.
Paul, do you want to continue in terms of some of the other opportunities that we see in the physical markets right now?
Yeah, well, we'll talk through a couple of examples. But on this slide, we have the term structures of 3 different locations. And certainly the WTI term structure should look familiar to some, but it's that's flat price. And then we've added in a couple of differentials, one for LLS, which is Louisiana onshore price differential, and for the Midland WTI differential. And just wanted to point out that when you look at how the spreads have been moving over time, and this is a look at 2011, 2012, 2013, and this year, these are just moments in time of what the curve looked like. And I think that what we're arguing, especially as we move through 2012, 13, and 14 on the WTI term structure, is that the back end is the curve is a lot more, the spreads are a lot more volatile because of this what we call duration mismatch. So supply-demand balances get realized in the front of the curve, and it says that, hey, crude's worth 95 or it's worth 100, but the back end, all we have are sellers, 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 because there are no natural buyers out there, and the banks and whoever they can move these commodities to warehouse them say, well, I've had enough at 85, I'll take some more at 82, I'll take some more at 80, I'll take some more at 75. And I think they effectively run out of capacity, but it doesn't really tell us about where supply-demand balance is going to realize. And I think that's when we look at natural gas or at oil, especially natural gas, is a little bit easier to see, is that there's pretty compelling value from a consumer perspective on that curve, and for a bunch of different reasons. But one of them is, we're starting to get below the cost of production in a number of different basins, and there's just no natural buying out there. And I think that if the really the spreads would come back into line again with capital to value them where they're properly valued, and that's really the opportunity. And so if we go back to the oil page, just wanted to point out another thing is that I think that the market is very used to looking at either WTI or Brent, but as we increase production in the U.S., some of these basins are producing, they're trading and producing a lot of crude, and the differentials are so volatile because of the infrastructure issues on the pipeline side that it creates an opportunity again for levered producers who have to come in and hedge. It creates effectively a downdraft in prices for producers that have to come in and hedge. That doesn't necessarily mean that prices are going to realize where they are. So I think that there's big volume trading in Midland now. There's certainly big volume trading in the Gulf, and there's a liquidity issue there because the current regime of capacity is just a lot less than where it used to be 3, 4, 5 years ago, and the need for liquidity out here is increasing. And I think that starts to be really interesting when you look at the volume that's approximating trade at Cushing from a physical perspective, and you see really how bent out of shape these curves can get, and really what happens when they bend back into maybe something close to reality. And I don't think we've even seen it on these curves. And if we move to natural gas, again, the NYMEX contract, for example, focuses on onshore Gulf Coast buyers and sellers. But we have production in the Marcellus region it's higher than any other basin's ever been. I think we're up over 17 BCF a day, and we'll argue that Rockies never topped more than 12 BCF a day. But these are big places of buying and selling, and these basis curves tend to overshoot what the fair value of actually getting the commodity to market would cost. And I think there's an opportunity there, especially for liquidity, just because there's so much one-sided deal flow that they can't, the banks can't hold on to anymore until they lower price. And I think that's, when you look to how supply-demand balances are going to change moving forward, that looks really interesting to me from, again, a value perspective. One other example is where the market, the physical market and the financial market, again with liquidity, have kind of disconnected is primary aluminum. And when we look at this, we see there's the financial market where most speculators sit has really disconnected from the physical markets, and it has to do a lot with the warehousing and the queues in the aluminum market that I think are going to get rationalized out. And so what we'll argue here is that the cost structure of aluminum, we're still sitting right on top of where kind of break-even prices look, if you look at it from the financial perspective only, but the producers are getting this additional Midwest premium, which is much harder. It's a more opaque market, and it's much harder to see. But I think the opportunity here is that, again, consumers got burned when aluminum was trading at the all-time highs. They're a lot less in this market, so the deal flow is really looking to, well, how do I warehouse it in a financing deal? But if those are going away with higher interest rates, then really I've got an issue, because that premium is going to go back to maybe the normal paradigm, but that means that premium dollars are going to have to ship back into the primary aluminum term structure. And I think that looks really interesting too, as again maybe just the rules change, but it's a regulation issue and an LME rules issue. But I think that market is setting up to say that, hey, we need liquidity providers, because the producers are out there banging the back end of the curve when it really deserves to be more in steeper and higher values going forward, and I think especially if interest rates go higher.
Thanks a lot, Paul. It's given us a lot to think about. Just moving on to the third point that we'd like to make is what are the current opportunities. So we've highlighted quite a few in the macro space and the micro space. Just I think what Paul ended on, and it's your personal view. If you think rates are going to increase in the next few years, there's clearly an opportunity for commodities. And I think the other thing to think about and that's from a macro perspective, from the micro perspective, is whether or not the U.S. will be exporting commodities, and whether that transpires, in the next few years. That's another thing to think about.
Exporting crude oil.
Yeah, exporting crude. So that's something. Those are things. Two very big things to think about. If we look at what's available, so back to Ollie's question about, so let's get back to BTS, and what can we do today? And just given where we are in the liquidity spectrum, knowing that while the picture and the visibility is improving in the very back of the curve, that we're not completely there yet. So what products are out there, to take advantage of? I talked a lot about the first generation of products, which BCOM is one of them. Second generation of products is our product Roll Select, which actually optimizes roll for each commodity within the index, which is the same commodities that are in BCOM out 9 months. And as you can see this chart, you can see how Roll Select performs versus two of our other forward indexes, the F3 index, which rolls to the third forward contract, and F6, which rolls to the sixth, and versus BCOM. And so you can see it clearly outperforms, all of those indexes. Roll Select was started live in 2011, and we have back tests back to 1991. This is a product that we see a lot of interest in. in terms of, again, where we are with liquidity, where we feel comfortable with liquidity right now in the underlying commodities, and provides a significant amount of alpha. So this is one, that we'd like to look at more. Would love to talk to you more. There are ETFs available on Roll Select as well as Econ.
To clarify, Carolyn, on the Roll Select methodology, the commodities in the Roll Select methodology are the same as in the first generation products, but the allocations occur on different parts of the futures curve to optimize the roll costs, or whether it's contango or backwardation, right? And the commodities themselves are not switching in this particular methodology, but where the allocation is on the curve is. Is that correct?
That's exactly right. That's right. And
okay.
So it's optimizing among all the commodities, and again, the same that are in VCOM. So that gives you that diversification, because again, every commodity can act differently. As we see, there's different fundamentals that are driving the different commodities. I mean, as a diversifier, as a broad-based commodity solution, as we've seen in terms of its return, and some of the studies that have been done, we're tremendous advocates. But this product actually differentiates between the commodities.
And tell us what we're seeing on this chart, just to be totally clear about this. Clearly, the Roll Select, I presume, is the higher line, complete with the back. Yeah, okay. And down below in the red and the green, we're seeing first generation indexes that don't, that they're front month exposures, or what?
Sure. So those are two sub-indexes that are part of this family of 2,000 indexes that make up VCOM. The blue line is F6, which is a programmatic forward-looking roll product that rolls to the sixth contract, and that's for every commodity that's in VCOM, it rolls to the sixth forward contract. So it is across every commodity is the same, and then below that, the F3, which is rolls to the third contract, and then the green line is the VCOM, is the first generation product. So
which is the front month, right? When you talk about VCOM in this context, okay, got it.
Yep.
Can you talk tickers for a moment? Actual securities, whether in an ETF or ETN wrapper, that have the benefit of this Roll Select approach to the futures space.
So we have, there are several asset managers that run products that are linked to Roll Select, as well as VCOM. A couple that we can share with you. So there's clearly the VCOM family, and if you've got a terminal, if you type in VCOM Go, you'll get lots of background on the whole family. And then in terms of some of the asset managers that are out there, there is the Roll Select product that we have, and then there's iShares, which is BlackRock's product, which is CMDT. That's one of the providers that's out there. There's also a few that have just started as well, and then we have VCOM linked ETPs that are with ETF securities, and I can provide those.
And the iShares security you just mentioned was CMDT,
Yep.
Charlie, Mary, David, Thomas, right?
Yep.
Okay, and that has the Roll Select methodology, right?
Yep.
And then on the flip side, DJP, which is quite a large security, almost $1.5 billion. That's first generation, right? The iPath Bloomberg Commodity Total Return ETN?
Yep, exactly.
Got it. Okay, great. No, that's very useful, Carolyn. Sorry if I interrupted your flow there. I just wanted to kind of really identify where that rubber meets the road.
No, and we're happy to talk to folks about the entire universe, and looking at different products, and even I alluded to products that go out a little further in tenor. There are a few, not many, but we can also speak about those.
That's perfect. Yeah, it would probably be useful before this webinar is over. We have about another 10 minutes for you to include a way. Well, you've done it right here on this final page. But yeah, please note, how to get in touch with either Carolyn or Zeph, because this is a complex space. And thank you. That's pretty much for your prepared comments, right? We can swing into Q&A. Is that fair, or am I cutting anyone off here?
Nope.
Okay, perfect. So I just want to remind audience members that you can ask a question at the lower right of your screens at any time, and we have a good 10 minutes, so thanks for leaving that runway, because Q&A is always good. You referenced a moment ago, Carolyn, I believe the research of Gary Gorton and Geert Rauwenhorst, the Facts and Fantasies paper that they wrote in 2005. And I'd like you to sort of remind folks what that's about. I mean, it really is it may not be an original insight, but it seriously popularized the entire futures-based investing world. Can you touch on that a little bit, just to make clear what the implications are in terms of asset allocation, please?
Sure. And I was happy to hear that it was discussed in some other sessions. But the papers that came out kind of in the early 2000s, mid 2000s, really talked about commodities outperformance with similar risks to other asset classes, specifically equities, and the non-correlated nature of commodities to these asset classes. And it really was the basis for this change in allocation from a lot of asset managers, and really sparked a lot of work that has gone into more flow into the commodity markets. And I think you really saw that kind of pre 2008. And frankly, post 2008, but however, because of where commodities have been in terms of their fundamental cycle, you've also seen outflows that have kind of masked that. So that's very important work. And from a backdrop as well is that there's commodities can at times really outperform, and so the diversified portfolio has been embraced, by a lot of the asset management community. And we'd love to see some updates on that. And I think that's coming.
Yeah, I think that they are going to update their data set to add another decade to it, and it's going to encompass the great downturn, which did a lot of crazy stuff to correlations, and I think it's led to some incorrect conclusions. I think some of this thinking that maybe commodities aren't everything they were cracked up to be is based on that episode of this so-called balance sheet recession that caused correlations across all asset classes to get really high for a short spell, and people lose perspective on that. I wanted you to answer, perhaps this is a question for you, Zeph. You guys can decide who's most fit to answer this, and this is a very elementary question, but I ask it because I know that there are investors and advisors out there who are really trying to do the best they can in terms of fiduciary duty to their clients, and they want to really get their heads around this futures-based commodity space. What is the purpose of these next generation methodologies? What is the alpha, or what are you trying to avoid? And it's a kind of a wordy way of alluding to the contango and backwardation. But I wonder if you guys might frame it up for listeners who may really be trying hard to get their head around something that's terribly important, please.
Absolutely. So let's just address the shape of the curve. The oil curve has had the most dramatic shift in recent months. So on your Bloomberg terminal, if you run CCRV on the shape of the forward curve for crude oil today versus versus July 1st, for example, you'll see this dramatic shift in the curve. And all this is driven by supply and demand fundamentals. So in terms of what part of the curve do you want exposure to, it all depends on the shifting supply and demand picture. Now bear in mind, as oil prices go lower and lower, you're disincentivizing investments in new oil products, especially the long duration deep water projects. Now here I'm thinking of deep water Gulf of Mexico, the Arctic, parts of the North Sea, parts of Africa. If oil prices keep grinding lower and lower, you will disincentivize some of the shale production. So at the same time, you're stimulating demand because lower or oil prices have a big stimulative effect on the economy. So now you can theoretically end up with a situation where you will not get new supply, the big long-term projects will be disincentivized, and the lower prices go, you end up setting up a bigger springboard bounce a few years down the road. And since the horizon of these long, deep water projects that the big major companies engage in is to the order of 4 or 5 years, I would expect a big reversal of this situation when that supply and demand balance shifts from an oversupplied market to an undersupplied market. So in terms of the shape of the curve is extremely important. It's just a view on forward supply and demand. And that changes every day due to geopolitical reasons, fundamental reasons, reasons to pressure Russia, and we can go down the list. The oil markets and commodity markets are always very interesting, and having the discretion to get exposure to the right part of the curve enhances your returns considerably.
To be clear, these indexing methodologies, as the name indexing suggests, these are rules-based approaches to that kind of optimization you were talking about, Zeph, and these are not quote-unquote active strategies, right?
Exactly. It's rules-based, so the market is essentially giving you a sort of view on the forward supply and demand picture, and that's all the forward curve is. And some of it has been dislocated. And the lack of liquidity in the back has sort of exaggerated some of that, and that only creates a bigger opportunity.
Right. Now, this question came in from the audience. It may be beyond the purview of what you are willing to talk about or even as index designers and providers, but I'm going to give it a try. The question is, could someone discuss the value of choosing optimal securities you hold collateral in so to enhance yield in these various strategy indexes?
The short answer is yield enhancement. In terms of how you choose the optimal securities, there are various different methods, and like any investment strategy, nothing works all the time. It's essentially it's a matter of putting it in the context of the investment regime is the short answer.
Okay, perfect. Another interesting question, again, possibly beyond your purview, but it's an interesting one, at least to me journalistically. Question about CalPERS removing hedge funds from their approach recently. Don't they want negative correlations? And in some sense, that's what we're talking about when we talk about commodities, is something that zigs while the rest of the asset classes are zagging, right?
Well, let's look at CalPERS' main objection. CalPERS wants the benefits that the hedge funds provide. They're opposed to paying the outsized fees that come with hedge funds. And the reason why ETFs are picking up in popularity and products such as these have a very interesting place in the market is because they provide hedge fund-like exposure with an extremely low cost and fee structure.
Right, and for example, just so the audience knows, I'm CMDT, that was the iShares one that has the next generation methodology. That's a security that comes in. I think the expense ratio is 75 basis points. So yeah, next to 2 and 20 that hedge funds have historically charged. That is the bargain of the century, I presume. That's kind of what you're getting at, right, Zeph?
Exactly.
Yeah, perfect. All right. Well, that is about all the time we have this afternoon. Commodities versus the world and why they are still a valuable investment. This was the third of 5 webinars that we're doing here at ETF.com during our Inside Commodities Week. Tomorrow we're going to talk about gold, and then the series concludes on Friday with the discussion on MLPs. Carolyn and Zeph and Paul, thanks for being here, and thanks to the audience for attending and for asking some incisive questions. On that note, on behalf of my colleagues at ETF.com and on behalf of my guests, I'm Ollie Ludwig, wishing you all a pleasant afternoon.